You know what is one of the most useful concepts in finance? Present value. And that's exactly what this lesson is about today. What does present value mean? Present value, PV, is the current value, that is, the value in today's dollars of a future sum of money. Let's do an exercise. I could pay you $100 today, or 1 year from now, I will pay you $110. No questions asked. How do you compare the two and see which one is better? If you're going just by the absolute value, you would definitely choose $110 because it's more. But let's say you could invest money today, risk-free, for 15% interest. How much is that $100 worth a year from now? If you take the $100 today and put it in the 15% investment, you would end up with $115. That's 100 times 1.15. So just going from what we just did, option 1 would be the better choice. What if we wanted to go in the other direction? Let's say we are going to be given $110 a year from now, and we wanted to know what it would be worth in today's dollars. Well, what did we do to figure out what our $100 today would be worth a year from now? We multiplied it by 1.15, our interest rate. So to figure out what the $110 we would receive in a year from now would be worth in today's dollars, we need to divide by 1.15. So 110 divided by 1.15 equals $95.64 roughly. So the 110 we receive a year from now would only be worth $95.64 in today's dollars. By the way, when we are figuring out how much our $100 is worth a year from now, we multiply it by the yield, or our interest rate. When we want to figure out how much the $110 1 year from now would be worth today, we divide the amount of money by the discount rate. We discount the money we receive in the future with the discount rate to find out its value in today's dollars. They are the same number, 15% interest rate, but depending on how we use the interest rate, it can be the yield if we want to know how much we would earn in a year investing today's dollars, or it is the discount rate if we want to know how much a sum of money we receive in the future is worth today. In our example, the $100 we receive today is worth more than the $110 we receive 1 year from now if the interest rate was 15%. However, what if the interest rate was only 5%? Well, now we have to calculate each of these again. So if we divide $110 by the discount rate of 1.05, we would get approximately 104.76. We can already tell by the calculation that the 110 we would receive 1 year from now would be worth more than the $100 we would receive today if the interest rate was 5%, because our $110 we receive a year from now would be worth 104.76 in today's dollars. If we multiplied the $100 by the yield, so 100 times 1.05, it would only be worth $105 a year from now. In the next episode, we will dive deeper into present value. If you found this episode helpful, please give it the thumbs up and share it with your friends. If you feel inclined, please like us on Facebook, subscribe to our YouTube channel, follow us on Twitter and Instagram, and if you really want to, subscribe to Gennecho's weekly newsletter. We will give you all sorts of advice, tips, and strategies to all things finance and investing. Just click the link below and enter your name and email in the form provided. Thank you so much for watching, and have a great day.